another important factor that we can see here, there is also some difference, but not many difference. Well, by the way, sorry, this I forgot to mention to you, but these values here, these were calculated in phi. Okay, so this is phi. But if I do the same calculation, I can do the same calculation in the domestic currency. I would get probably not too much difference from these results. But again, this is an important question of how, in which currency should we look at performance. So there are basically three currencies. We have a home currency, a so-called home currency. Second currency is the local currency. And these are concepts that are important. And third, this is a neutral currency. Okay, in this case, if we were an investor, an American investor, of course, my currency would be the dollar, fine, right? So if I were investing in the US, which I would be, because this portfolio is only US stocks, then the local currency would be also in dollars. So if I use these two, American, investing in America, so the dollar would be fine, would be just the currency. But if you want to compare with what I could achieve elsewhere, outside my country, then I would need to go to a different context, and I would have two options, either to choose a different currency from my home currency, arbitrary, I may choose, say, the euro or the yen or whatever, or choose a neutral currency like the FEI, which is not, it's an index, it's not a real currency in the sense that it was issued by a central bank in a given country. This is a unity of account that we can use. And how why should an investor, an American investor, for instance, decide to assess its return into this neutral index, this neutral currency like the FEI, instead of using his currency? Or imagine that this American investor was investing in Europe. So in that case, the currency would be the euro, and he could still measure the return in dollars, although he was investing in euros. But he could also assess the return in FEI. The reason why a neutral currency is better is because it allows, in fact, to compare with multiple markets, not just the one specific market, but with multiple markets. And also one reason is that this type of instrument could eventually allow the investor to hedge his positions wherever they invest into this neutral currency, which is a weighted basket of all the other currencies. He could invest like this. So the choice of currency when assessing and trying to understand the allocation of our portfolio is likewise an important issue. And the other important issues that we have to consider are, of course, the diversification in terms of industry, in terms of size, in terms of whatever criteria you want to use, in terms of rating of the stocks and so on. It's also, again, an important matter that we want to understand when looking at our performance. Now, finally, an important issue is this question of to hedge or not to hedge. So if I'm investing in a currency, so let's say I'm American, I'm investing in Europe, should I hedge my investment in Europe so that I isolate the return on the euro or the loss in the euro, or shall I take the risk of of investing in a different currency than my own currency. So there is an instrument that sometimes is confused with investing in local currency, which are the so-called ADRs, American Depository Instrument. Receipts, sorry, not instrument, receipts. And if I invest in ADR, so I buy it in the US, and it is also, so I'm an American, I'm buying an ADR that is in US dollars, but this ADR corresponds to a share in a euro-dominated account. So does it mean that I avoid the currency risk? Of course not, because this reflects immediately the changes in price. The fact that I'm paying and look at an instrument that is in US dollars doesn't avoid the currency risk, because of course the instrument is just a title, it's just a receipt for a euro denominated asset, and of course the price is fixed in euros and it's reflected immediately in $2. So it's not a protection against currency risk. It's just an alternative instrument, but it's not a protection against currency risk. If I really want to protect against currency risk, I should hedge my positions. We have a tool here to do that. I'm not going to show you right now because it's a bit of a sophisticated tool, and it still has needs a bit of improvement. But just to tell you, the basic idea is that if you are a small investor, you should not hedge. So basically, you should not hedge if you are a small investor. If you are a large investor, then you have to look at the hedging or not, depending on the strength of the currency where you are. If you are in a country or your home currency, if your home currency is a strong currency, of course you don't need to hedge. On the contrary, if you are in sorry, I just said the opposite. If you are in a strong currency country, you really need to hedge, because very likely your assets in the local market will depreciate, change in value when you convert them into your home market. If it's the opposite, if you are in a country with a weak currency, then you don't need to hedge, because the currency of the other countries will improve in relation to yours, and therefore you don't need to worry about hedging the currency risk. But if you want to be neutral in terms of currency risk, then, and if you have enough money to support the costs of hedging, then you should consider hedging. And you may even consider hedging in relation to a neutral currency like the FEI, for instance. Okay, so these are the main issues to consolidate our discussion on attribution and hedging.